Hello and welcome to another edition of the Moving Iron Podcast. This podcast is proudly provided by Axon, helping dealers move more iron for almost 100 years. Find out more at axontire.com. Axon was started almost 100 years ago out of a passion for keeping agriculture moving. It's that same passion that drives them today. With a vision for a better experience for both farmer and dealer, they set out to create a better way to move more iron. When you partner with Axon, you get immediate access to a full range of products and solutions designed to meet the complex needs of today's grower. Axon carries all major brands and sizes of tires, wheels, and tracks. From custom colors and sizes to fully customized wheels, you can have the solution for virtually any problem today's farmer is trying to solve. To find more or become an Axon dealer, please visit axontire.com.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron, time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast Markets with Shawn Hackett. This edition of the Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years. For more information, go to axontire.com. And also, if you're looking for a great place to help your salespeople manage their clients as well as their sales progress, check out Arrow at heyarrow.com and see all their great products there. Shawn is with Hackett Financial out of Boca Raton, Florida, and I am gracious enough to have Shawn here 2 times a week to talk about what's going on, and this is the Tuesday report. So, Shawn, how you doing this morning?
I'm doing good. I'm really super happy to be back in South Florida after a long trip and fired up again. I'm fired up.
Yep, so. Fired up, ready to go, and talk about all the great things that are happening out here. So, one thing that I've been looking at, and you've talked about it on here quite a bit. We've talked about current range of corn where it's at. It's going to struggle to make things work just because of the input costs that we see coming down the pike here for next year. We're looking at some possible weather delays and those kind of things. We got supply chain issues that are coming up, and then inflation is still a deal out there now. So I guess as you take a look at corn, I think right now we're at 572. I think is what it closed at yesterday. I haven't seen what the overnights have done, but when you take a look at corn, when do you think inflation is going to start playing a big role in what we see? Obviously, supplies are high right now because it's we're in the middle of harvest and those kind of things. But when do you really feel like that inflationary tick that we've seen kind of get peanut buttered across the entire economy is going to hit the commodity markets here?
Well, we had the first phase, and we've been consolidating.
Right.
I think the corn chart is a perfect chart because we made the high in May, and we basically have been going sideways in this volatile trade ever since, consolidating that first initial inflationary move. And our view is that we're going to start a secondary inflationary move. Wheat's sort of maybe already starting that early because of the high quality wheat shortage that we clearly have, and it's trying to ration demand. So wheat's probably the first market that's beginning to break out of that consolidation. And you can parlay this into a lot of other markets, but every market's going to develop this next wave of inflation based upon its own cycle, its own supply demand fundamentals. Cotton is already breaking out of its consolidation because of China's demand for cotton and that sort of thing. So for corn specifically, corn's being dragged up by its feet by the wheat market, which is typical. That's wheat market takes off, corn goes along with it, but it's really not I don't see the fundamentals allowing the corn market to go much above, this $5.80, $6 area for right now. I think there's plenty of corn from harvest. Crop conditions so far, especially in Brazil, look okay. And I do think that the wheat market is nearing a crescendo of price rationing high quality wheat, meaning it's going to front it load it, get it high, make sure that it can get to the next harvest. And I believe we're pretty close to doing that. Now they're assuming we're going to have a good crop for the winter wheat crop. I don't believe that's going to be the case, but for now they're going to assume big crop. We've done enough. We can get through. We've told the marginal buyer, don't buy high quality wheat. It's not for you. So I believe that what's going to start to happen is we're going to get into like January and February, especially February, that's when we price the insurance for the following season, right? We the February price is how all your insurance products get priced, of what your protective price is on your crop insurance in the United States. And so everyone's going to start looking at that price, assuming it's December 22 corn is what, 550, something like that. Assuming we're in this low fives, and we're going to start looking at what does that mean for acreage in the U.S. What does that mean for yield? How much fertilizer will the farmer put down? And I believe that the balance sheets are going to start to look. They're not. The math isn't going to work. I mean, we're going to put 88 million acres instead of 94. We're going to start putting trend line yields, and that's not going to work. And then we're going to realize that we're going to hear all kinds of talk that the fertilizer is going to be cut back. And oh, by the way, we're going to have some weather problems, delayed planting, even less. I just think the market's going to look at the balance and say, wait a minute, we got to get this corn price higher and change the farmer's mind before it's too late. And so I really think February and March begins that process. I don't believe the corn market's going to wait for the crop not to get planted. They're going to say, wait a minute, we need to get prices up and get that guy to go out there. I still don't think they're going to get planted because of the planting season is going to be very, very poor for getting the crop in the ground. But I think February, March is when I would anticipate, Casey, the corn market really having to do something more dynamic to the upside to get acres sufficient that it can work if the crop's good, if the crop is good. In the meantime, I still think once wheat tops out here, it's still going to be kind of a consolidation back and forth. Unless Argentina really, really gets into a weather problem later in December into January. So I think there's a potential that could happen. But for now, corn is strictly going up because wheat's going up. So
gotcha. Okay. How much? How do I ask this question? How much do you think the March prospected acreage report is going to, or prospected planted acreage report is going to, affect? I think if fertilizer is going to be an issue, nitrogen is going to be an issue, and those kind of things, there's more soybean acres are possibly going to get planted than corn, so on and so forth. There could be this big reversal here where the number of corn acres drop significantly. I guess how much of an effect do you think that'll play, and then how much do you think that's always kind of been like a little boy that cried wolf type of report, I guess, a little bit to some extent. Do you really think that's going to make that much of a difference if it's dramatically off? If it's corn's off, 5 million acres from what it was this year.
I have to believe the market's going to anticipate that report, Casey. I don't think the market's going to wait for the USDA. I think the market's going to start to figure out those acres are going to be down, and they're going to try to do something to override that. Remember, we get the Ag Outlook comes out. I'm trying to remember when that comes out. I think it comes out in February, and that's the USDA's trial balloon. They throw out some numbers, and this is not a secret. It's not like I think the market is going to front run that, and it's going to try to get the farmer to make a different decision so that number in March that they come out with doesn't look so bad. That's why I'm saying I think February into March, the market has to rally so that we plant sufficient number of acres. And then of course, if we have delayed planting, if we have late ending winter, if we have flooding, well, then of course, we have a whole nother problem that even if they say we're going to plant so many acres in March, we're really not going to be able to get those acres planted. And then the market has to recalibrate again of what does the corn price have to do to reflect the idea that we're not going to actually get those acres planted. And oh, by the way, because of the problem with the planting season, oh, by the way, those trend line yields that we dialed in are probably not going to be the right number. We need to go. And then you have a big problem in your hands. You got a really big problem here. We have no buffer stocks, so just a little of adjustment, Casey, and we're out. And we're out. We're doing what wheat's doing now. We're price rationing. We haven't priced. I think we're going to have to price ration corn as you go into spring, early summer. If I'm correct about what's to take place here.
Yeah. Yeah. Okay. So you've got some reports out of China about some food shortage concerns that are popping up. They're telling they're basically telling their people, hey, need to keep some basic fundamentals on hand because we got a winter coming up that could be pretty rough. To me, that's one more of those telltale signs of what's coming down the pike. Especially with China and they're having their brownouts the way they've had them, and the spike in heating costs and those kind of things with natural gas the way it are. I mean, so I guess talk about that impact. I guess as that moves, I guess from the east to the west.
It's the concept, we've talked about this before. Security of supply is taking precedent over the price that you pay. Mm-hmm. For 20 years, it was just in time. Whatever we need, we can buy it. We can get it shipped quickly, just in time. It's efficient use of capital, but just in time.
Right.
Weather's good. We're producing technology is helping us. And then the pandemic hit, and we got into these shortages due to logistics, worker problems, of course, the shipping issues, and now we actually can't get what we want right away. You say, all right, I want some corn from the U.S. You're not getting it right away. You don't know when you're getting it. You just don't know, and that's not comforting. When you say I need it now, and you're not getting it now, so everyone, including consumers, is starting to figure out, I had just enough in the house for 3 or 4 days. Maybe I need just enough in the house for 3 or 4 months. Mm-hmm. And maybe as a government, I need rice and wheat and, for a year's worth instead of 3 months worth. Everyone is rethinking what they need now because this has been a shock to the system. And if we do have this very, very long destabilizing winter, it's going to even bring that concept further home to roost. So I really feel that there's 3 things going on here. Dramatic increase in weather volatility. We've talked about this, and that's creating shortages. The second thing is the idea of the global logistic system out of whack. And thirdly, the idea of restocking the world. Well, you're not going to restock the world in 1 month, Casey. You're going to restock the world over the course of 2 to 3 years.
Right.
Assuming
everything goes
right,
yeah.
Assuming you have good crops and big crops and surpluses, and you can do it.
Yep.
If you don't have good crops, it takes even longer. So not only do we have to satisfy the actual demand for corn, for example, but we have to satisfy the demand for corn that is being asked to stockpile. So that's a huge increased demand base, Casey. We have not seen in a very, very long time. We saw a little bit of this in 07, 08. We saw some restocking demand when we had that food shortage or the food crisis we had for a little while, but didn't last very long. So that's what's really powerful about this cycle. It's a combination of a lot of things, but there's no way that we're going back to just-in-time ag inventory. We are going to stock up, rebuild, and have that buffer stock. And until that's satisfied, the demand for food is going to be much higher than everyone is anticipating. I'll just look at the cotton market. Something, by the way, that's not actually necessary, right? We don't eat cotton.
Yep.
We got to be close to where, but for the most part, it's not like it's a crisis issue. But even there's a shortage of high quality cotton. And so China is buying all our cotton like we've never seen before because they don't have any high quality cotton and neither does anybody else. And so they're coming for the high quality cotton. They're stockpiling the high quality cotton because they're afraid of running out of it because they need that high quality cotton to mix in with their crap that they produce so they can produce the products that everybody wants.
Yeah.
And this is a market that's not necessary. So it's a classic example of stockpiling, even something that you don't absolutely positively need as a human being, but they need it because their textile industry is dependent upon it.
Yep. Yeah, that's a good point. You're seeing that happen. So I guess let's jump over and talk a little bit about what's going on in the livestock markets here a little bit. If you take a look at what's going on, you have box beef prices are starting to kind of firm up a little bit from what they've been. They've been bouncing around all over the place, and you're starting to see some firming up of live cattle as well. So I guess when you look at that cattle complex right now. What are your thoughts there?
Yeah, we had a rally. We had the first break in the fall here. That we had kind of a bounce off that break, but I still feel, we have too many animals for the throughput capability of U.S. packers. It continues to be a problem. We continue to hear about workers not showing up, and just too many animals for the capacity of the industry, and so that's continuing to prevent the cattle price from really delivering on where the beef price has been for a long time, which is through the roof. The cattle and feed numbers continue to show smaller numbers coming. And so when we look at how much the herd is thinned out over the summer into the fall because of the drought, because of high feed prices, with the winter we expect to see, the more thinning out, the reproductive cycle being disrupted, we think that the supply of animals for cattle are going to be insufficient from the spring onward, where we take the packer problem off the table, meaning the animals will be sufficiently low by then, Casey. Demand is going to be there. I'm not worried about the demand for beef. It's going to be there. We just got to get the animals down to where there's not a throughput issue, where the packers have to bid up these animals because they can bring them through as fast. They can't bring them through fast enough. We haven't been able to do that, and I think we need a little bit longer before we get those animals in the right place. But once we do, it's going to be a really, really dynamic move to the upside. And that's why we've continued to focus on your show, and in our recommendations is to be looking at spring, summer, and fall feeder cattle and live cattle. The feeder cattle market tends to go up first, and then it leads the live cattle market thereafter. So if I was really looking at where I think things could go pretty interesting, we talk about the inflation. When inflation could really kick into the cattle market, it's the spring, summer, and fall of 22. I think we're going to chop around a lot here between now and then, unfortunately, because I just think we still have too many animals to get through this unfortunate limited capacity of a concentrated industry that probably not to have gotten that concentrated, but there we had to, whether we like it or not, that's the situation we have in the cattle business right now.
Yep.
So,
okay, hog market is still, it's just been struggling here. I mean, it continues to just have those weak moments, takes a step forward and takes two steps back type of thing. When you look at what's going on in the hog market, like you've talked about here, we've hit that seasonal high kind of back in the summertime, and now we're kind of going through that seasonal low period that we see now. But it seems like it's compounding to some extent. When you look at the hog market, what are your thoughts there?
Until China comes back, remember,
right,
we geared up our production to sell all this supply to China because of the African swine fever. And that was working well. They were buying like we've never seen before, and it drove this market up well over $1 a pound. And then all of a sudden, African Swine Fever Act 2 occurred in China.
Yeah.
And they liquidated everything. And they crushed the hog price. The pork prices just got crushed. Massive oversupply. They don't need a thing right now. They won't need a thing into the first quarter. And they're not buying anything from us. Well, we geared up for it. There's no way to replace that demand through other sources. You can offset some of it, but not all of it. And so we're suffering from that. Prices are still attractive, and even though the hog and pigs report that we saw in the last USDA report that came out showed kind of a surprisingly smaller number of animals than was anticipated, we think that's just a transient thing. We think we're going to start building the supply, building these animals, building this herd as we move into the first quarter, and we think that supply is going to just be overwhelming. That's our view between now and then. I think we're going to make new lows in hogs. I just think we're not done yet. Now, that supply that they've unleashed into the Chinese market isn't going to last forever. They got their holidays, they consume tons of pork, and they're going to have to rebuild again. Rebuilding Act 2. And as they rebuild, all of a sudden the hog price is going to take off. Pork supplies are going to completely contract. They're going to have a shortage again, and things are going to go through the roof again. And they're going to come back for the U.S. saying, "We're back. Sorry, we went on vacation for a little while, but we're back. What do you got for us?" And that's a second quarter issue forward. So we're pretty optimistic that from second quarter onward, the Chinese demand comes back and can levitate prices again. So I really feel the hog producer needs to protect prices into the first quarter. I think after that, he's going to be fine.
Yep, I would agree with your synopsis there. They're talking in this article I'm looking at right now. They're talking about they're dealing with excess pork. This is from the Chinese now. So the Chinese massive hog sector is dealing with excess pork production after millions of small farmers started raising hogs as China's leaders called for an urgent recovery following the African swine fever outbreak. So now they're back to doing what caused the African swine fever to start in the first place. And they were just trying to, now they're saying they've got an oversupply, yet they're begging for, they're looking at all these different things from happening. So it's kind of like you say, there's just part two's coming again, and this might cause part three to happen. They're not careful.
We're literally going to play the record again.
Yeah,
we're going to play the record again. We're going to go through the whole record again a second time. It's amazing, but we are going to do it. So there's going to be tremendous volatility in U.S. hog prices, now down and then up big again. So just make sure, as a hog producer, just make sure you protect. Hogs are notorious for overshooting up and down.
Yep.
They overshoot. So whatever I think it should go, it's going to go a whole lot lower than we think, just because that's how livestock trade. Just protect yourself in the first quarter. I just think there could be kind of an ugly liquidation there before we get that demand back and see better times ahead. So if there's anything I could really stress, even though prices are down a lot from where they were, they're still not bad compared to where they had been or could be and probably will go. So still remind yourself, you're still surviving as a hog farmer at these prices.
Yeah.
So,
they're actually, in this same article, they're actually predicting, well, tongue-in-cheek, they're predicting this. They're saying, like, more than likely it'll take another large disease outbreak in the country this winter to eliminate some of the excess supplies. So they're anticipating. They're anticipating another round of African swine fever to go through. It's crazy. Absolutely nuts. All right, man. Well, Shawn, hey, good stuff as usual. Folks want to reach out to you, get more information about what you're doing at Hackett Financial. What's the best way to do that?
Our website is Hackett, Hackett, advisors.com. All kinds of information on there with videos and interviews and sample reports. In fact, we just did a market-to-market show on Friday that I think we'll be posting fresh on the homepage. That's kind of a, it'll be a fresh interview and those who want kind of a more.
Right on. Well, Shawn, thanks for being on the podcast. I always enjoy it.
Sounds great, Casey. I always love being on your show and talking agriculture. It's a passion of mine, as you know.
Yes, it is. Yes, it is. Well, I am Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram. You can also go to the fellows over at Farm for Profit podcast. They had me on as a guest talking about what's going on in the equipment industry from my perspective. And so check that out. Go over there and give those guys a listen. It's a good podcast, chock full of great information, and they're great guys as well. So if you want to check that out, go to Farm for Profit. You can find it anywhere that podcasts are played there, so check that out. Also go to MovingIronLLC.com for all the latest information about Moving Iron podcast, as well as Moving Iron Summit coming up. Should have information on that pretty soon. Also go to Facebook, Twitter, and Instagram. You'll see all the latest posts there as well. So with that, I am Casey Seymour with Shawn Hackett. Let's go smart, folks. Out. You want to have a meaningful competitive advantage to help sell more equipment. Whether you represent the sales, parts, or management department of an implement dealership, there's a surprising amount of complexity when it comes to tire, wheel, and track technology. Let Axon worry about that so you can get back to supporting your customers. Axon has leveraged years of experience to create a streamlined process that gives you a proven path to help today's grower and sell more equipment. The roots of their organization go back almost 100 years to the invention of the rubber tractor tire. Supporting agriculture is the number one driver of Axon, from product development through sales and service. To find more or become an Axon dealer, head over to AxonTire.com.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron, time and time again. Through the years you'll find us here. fire.